Welcome to the deep dive, where we really dig into the information and pull out those critical nuggets of knowledge. Today, we're taking a close look at Abbott Laboratories, that's ticker ABT, as things stand on June 21, 2025. Now, before we get started, just a quick reminder, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And for just $4.99 a month, members get priority on ticker deep dives, plus exclusive daily videos. Definitely worth checking out. So our mission today is to tackle a pretty fundamental question. You have this 137-year-old giant, Abbott Labs, in a healthcare world that's, evolving incredibly fast. Can it just survive, or can it actually thrive? We're going to be working from a detailed report, looking at it like a value investor would, focusing on the durable, long-term stuff. And here's where it gets really interesting. Despite its age, despite all the changes, our analysis suggests Abbott's current stock price, around $132.41, might actually be trading at a notable discount to its real intrinsic value. How does that even happen? Let's unpack this. Okay, let's begin our journey.
Let's try and understand the foundation of Abbott Laboratories first.
Business understanding.
So, at its absolute core, Abbott's business model, it's really built on diversification, very resilient diversification. They've got these four main segments, right? Medical devices, diagnostics, nutrition, and established pharmaceuticals.
Yeah.
Roughly equal in size, too.
Exactly. And that structure, it provides real stability. It kind of insulates them if one segment faces challenges.
Yeah, like you saw post-pandemic, right? Diagnostics, the COVID test sales, they naturally came down. But the medical devices side was growing strong, and that really helped offset it. It's a great example of that resilience.
It really is. And their revenue streams, they're quite multifaceted. You've got the one-time sales, big equipment like lab analyzers, but then you have the recurring revenue.
The consumables, the test kits, the classic razor and blades model.
Precisely. Especially in diagnostics, it creates a very, very sticky customer base once a hospital invests in their systems.
Makes sense. So looking at the actual numbers, what did 2024 look like?
Okay, so full year 2024, Abbott reported sales of just over $40 billion, $40.1 billion to be exact. Medical devices, that was the biggest chunk at $16.8 billion. Then diagnostics at $10.8 billion, nutrition at $8.2 billion, and established pharma at $4.3 billion.
And it's not just a U.S. story, is it?
Not at all. Around 70% of their revenue actually comes from outside the U.S. And get this, about half of their total revenue comes from faster-growing emerging geographies. That global reach is key for diversification.
Wow. Okay. And the products themselves, we're talking about some pretty life-changing technologies here.
Absolutely. In medical devices, they're leaders with things like the Freestyle Libre family. Those are the continuous glucose monitors for diabetes care. Huge market, plus a whole portfolio for cardiovascular health, MitraClip, HeartMate, and neuromodulation devices for pain management.
And diagnostics.
A really wide array there. You've got the big core lab systems, Alinity, Architect, but also the rapid point-of-care stuff like the iStat system, and of course those rapid antigen tests everyone remembers, like Binax NW.
Right. And nutrition. Those are household names.
Yeah, you've got Ensure for adult nutrition, Similac for infant formula, setting aside the recall issues we'll touch on later, and Pedialyte for rehydration. Very strong consumer brands.
And finally, Established Pharmaceuticals.
That segment provides high-quality branded generic medicines, mainly in emerging markets. Think well-known names like Brufen and Clasid.
This company is just enormous. 2025 ranked #144 on the Forbes Global 2000. Market cap, what, $235 billion?
Somewhere in that range, yeah. And operating in over 160 countries, 114,000 employees. Their leadership in areas like CGM, with Freestyle Libre being top 5 for branded generics in key emerging markets, that really cements their strength through scale.
So what's their core value proposition then? What are they offering?
I'd say it's patient-centric innovation. They're committed to developing advanced, effective tech that's also crucially accessible and affordable. Their 2030 sustainability plan even aims to improve the lives of over 3 billion people annually.
So for you, the consumer, it means brands you trust, products for your well-being.
Right. And for doctors, hospitals, it means efficient diagnostics, better medical devices that improve decision-making, patient outcomes, and importantly, cost-effectiveness. It's about shifting from just sick care towards proactive healthcare.
That proactive shift is huge. How are they positioned for the big industry trends we're seeing?
That's a great question. They seem really well positioned. In medical devices, you see trends like AI integration, wearables like Abbott's own Lingo consumer biowearables, and this increasing focus on sustainability. Abbott's playing in all those spaces. In diagnostics, AI and machine learning are boosting accuracy. Rapid point-of-care testing, like their ID Now and iStat platforms, is expanding massively, and non-invasive diagnostics are emerging. Again, Abbott's right there. And nutrition and pharma. Nutrition is moving towards personalized plans, gut health, nutrient density, alternative proteins. Abbott's science base gives them a strong platform here. Meanwhile, the pharmaceutical landscape is adapting to digital health, but always faces that pressure on drug pricing.
Which leads to competition. It must be fierce.
Oh, intensely competitive. They've got major rivals in every single segment. Medtronic, Boston Scientific, J&J in devices, Roche, Thermo Fisher in diagnostics, Nestlé, health science and nutrition, Pfizer, Novartis in pharma. That rivalry between Abbott's Amulet and Boston Scientific's Watchman in structural heart, that's particularly fierce.
Well, okay, so with all that competition, plus the nature of healthcare, how do they handle the regulatory side? That must be a massive undertaking.
It absolutely is. As a global leader, their products face incredibly strict oversight. The U.S. FDA is just one example. It governs everything from R&D right through to marketing. Compliance isn't just a department, it's a huge operational focus. Costs them billions. They have a dedicated Office of Ethics and Compliance. They have to follow laws like the Sunshine Act in the U.S., disclosing payments to doctors. And imagine doing that, monitoring and adhering to rules in over 160 different countries. It's a constant, expensive challenge.
But those challenges, they also act as barriers, right?
Right.
Make it harder for others to jump in.
Exactly. They're formidable barriers to entry. Think about the R&D costs, the timelines, they're prohibitive for many. Then there's intellectual property. Abbott has a vast portfolio of patents, and the regulatory hurdles themselves are immense. They've even got landmark Supreme Court cases in their history, like Abbott Laboratories v. Gardner back in '67, showing how long they've navigated this.
And then the advantages of being big.
Economies of scale, established distribution networks. These give incumbents like Abbott a huge cost advantage, plus decades of building brand trust. Names like Ensure, Freestyle, that reputation is hard-earned and hard to replicate.
So let's sum up their competitive advantages. What are the key moats?
Well, brand strength is undeniable. Ensure, Pedialyte, Similac, Freestyle. These names command market share because people trust the quality. Their corporate reputation, being on Fortune 500 lists, world's best employers, that hooks too.
And the scale gives cost advantages.
Definitely. Over 90 manufacturing sites globally. That means huge economies of scale in buying materials and production, lower costs per unit or higher margins. They even developed specific frameworks like a master MarTech system in Europe just to cut marketing costs. Their sustainability plan also aims to design for affordability, something only possible at their scale.
Okay, those are traditional advantages. What about more modern moats? Network effects, switching costs?
Yes. They've built those very skillfully. You see it clearly in diagnostics. A hospital invests in an Alinity or architect system. They become deeply embedded. That generates long-term, high-margin recurring revenue from the proprietary tests, the reagents, that run only on those systems. Switching becomes very costly and disruptive.
And Freestyle Libre. That seems like an even stronger example.
It really is. It's not just a sensor. It's becoming an integrated health ecosystem. More patients use it, more data is generated. Then Abbott integrates that data directly into major electronic health records like Epic.
So for both the patient and the doctor, switching to a competitor means losing that seamless data flow, learning a new system. Huge hassle, high switching costs.
Exactly. It creates a really powerful lock-in effect. That's a significant moat.
And finally, just their unique assets, the portfolio itself.
Right. That strategically diversified portfolio provides incredible resilience. Their R&D engine is highly productive, constantly churning out new products. Over 100 in development through 2027, more than 15 new growth opportunities announced just in 2024.
And manufacturing agility.
Critical. Remember how quickly they ramped up COVID test production? That showed their global manufacturing network's capability? Backed by big investments, too, like that recent $500 million in new U.S. facilities. These capabilities are very hard for others to replicate quickly.
That paints a very strong picture of the business itself. Let's shift gears now. Who's leading this company?
Management evaluation.
Okay, leadership. Robert B. Ford is the chairman and CEO. He took over in March 2020. He's an Abbott veteran, though. Over 2 decades with the company, which kind of reflects their culture of promoting from within.
And his track record.
Pretty strong. He was key in integrating that huge St. Jude medical acquisition, $25 billion, and launching Freestyle Libre, which has been, revolutionary.
But leaders are often tested in crises. How did he handle the infant formula recall in 2022? That was a big deal.
It was a major test, yes. The recall from the Sturgis, Michigan plant caused a nationwide shortage. Ford did something pretty unusual for a CEO. He wrote a public apology in the Washington Post. He acknowledged the situation, though he also noted that investigations, both internal and external, didn't find a definitive link between their formula and the reported illnesses. They worked to get production restarted quickly, set up a $5 million fund for affected families. But, despite those efforts, it's still a challenge. There are ongoing lawsuits, and an FDA report did find process control failures at the plant. It remains a blemish.
How do they communicate generally with investors, the public?
They're pretty transparent. Regular quarterly earnings calls, presentations at big industry conferences like J.P. Morgan. Ford's style seems direct, confident. Like when he addressed the GLP-1 weight loss drug trend, those new drugs like Ozempic. He publicly called it utterly positive for Abbott's diabetes business.
That seems counterintuitive, weight loss drugs helping a diabetes device business.
Right, but his point was reassuring investors. He argued that even with these new drugs, people still need ongoing monitoring, like with Freestyle Libre, to manage their overall metabolic health. It's not just about weight, it's about glucose control, other factors. So calm some nerves.
Okay. And ethics, compliance, beyond the recall issue.
They have a robust structure on paper. A chief ethics and compliance officer reporting directly to the CEO and the board. Mandatory code of business conduct training for everyone in multiple languages. However, they have faced scrutiny, some Better Business Bureau complaints, and that U.S. Senate Finance Committee investigation into their tax practices and share buybacks was significant.
Right, questioning how they used capital, especially during the formula crisis.
Exactly. It just highlights the intense level of oversight a company of Abbott's size inevitably faces.
So, with all that in mind, how does this management team actually allocate capital? What's their strategy?
You could call it a barbell strategy, balancing two key things. On one end, they invest aggressively in the future. Over $3 billion in R&D in 2023, that's nearly 7% of revenue, fueling that pipeline of over 100 new products, plus significant capital expenditures like that $500 million for new U.S. facilities we mentioned. That's the growth investment side.
And the other end of the barbell?
A disciplined approach to M&A, mergers and acquisitions. They've done huge transformative deals in the past, like St. Jude Medical and Alere back in 2016. Those really reshaped the company. More recently, though, they seem focused on smaller tuck-in acquisitions, buying companies like Cardiovascular Systems and Bigfoot Biomedical in 2023, mostly in medical devices and diagnostics, adding specific technologies or market access.
Okay, investing in growth, strategic M&A. What about returning cash to shareholders?
That's a critical part of their strategy, too. Share repurchases are common. The board regularly authorizes big buyback programs. There was a new $7 billion one in October 2024.
Tax efficient, but that's what drew some of that political fire, right? The Senate inquiry questioning if tax cuts funded buybacks instead of maybe, say, plant safety upgrade.
That was precisely the line of questioning, yes. It highlights the political dimension these decisions can have.
But the absolute cornerstone for shareholders has to be the dividend, right?
Oh, absolutely. Abbott is an S&P 500 dividend aristocrat. That means they've increased their dividend for over 25 consecutive years. In Abbott's case, it's an incredible 54 years straight.
54 years, wow.
Yeah. As of June 2025, the forward yield is around 1.78%. And crucially, the payout ratio, a portion of earnings paid out as dividends, is really conservative, just under 30%.
Meaning the dividend is very safe, well covered by profits, with plenty of room to keep growing it.
Exactly. That's a huge plus for income-focused investors.
And this ties back to something really compelling for value investors. Return on invested capital, ROIC. How does Abbott stack up there?
They excel here. This metric shows how effectively management uses the money invested in the business to generate profit. For the last 12 months ending Q1 2025, their ROIC was strong, somewhere between 20.7% and 23.0%. Now compare that to their cost of capital, their WACC, which is estimated at 8.42%.
So the return they generate is way higher than the cost of the capital they use?
Precisely. That significant positive spread is exactly what you want to see. It means their investments are highly profitable, very efficient. They are successfully creating long-term value for shareholders. It's a key indicator of quality management and a strong business.
Excellent. That gives us a good handle on the management and capital allocation. Let's dive into the raw numbers now.
Financial analysis.
All right, the financials. As of June 21, 2025, Abbott's market cap is hovering around $230 billion. Definitely a mega cap stock.
And revenue. How's the trend there, especially after the COVID testing boom?
Yeah, the last 5 years still an interesting story. You saw that big spike in 2021, up to $43 billion, driven by COVID diagnostics. Then, predictably, a dip in 2023 down to about $40 billion as that demand faded. But the key thing, in 2024, they returned to positive growth. Revenue hit nearly $42 billion, up 4.6% year over year.
So the underlying business showed its strength.
Exactly. And if you look at the 5-year compound annual growth rate, the CAGR, it's a solid 5.7%. For a company this size, that demonstrates real resilience in the core business.
How about profitability? Margins holding up?
Consistently healthy. Trailing 12-month figures show a gross profit margin near 56%, operating margin around 18.5%, and the net profit margin was exceptionally strong at almost 32%.
Wow, that net margin is high.
It reflects efficient operations and, likely, a very favorable product mix leaning towards higher margin areas.
And free cash flow. That's crucial for value investors.
Absolutely. Strong track record there, too. It peaked during the pandemic, dipped a bit in 2023 as things normalized, but then rebounded strongly in 2024. FCF was up 25.5% to over $6.3 billion.
So the underlying business just keeps churning out cash.
It's a powerful cash-generating machine, yes.
And financial stability overall. Earnings consistency.
Very consistent long-term earnings power. GAAP EPS can bounce around a bit, sure, but their adjusted EPS for 2024 was $4.67. That really highlights the stability you get from that diversified model.
And the balance sheet. You mentioned low debt earlier.
Yeah, it's a fortress. As of the end of Q1 2025, the debt-to-equity ratio was super low, 0.27. They finance way more with equity than debt, giving them a huge safety cushion. And the current ratio, which measures short-term liquidity, was a healthy 1.78. They can comfortably meet their near-term obligations.
Plus that dividend aristocrat status we already covered. 54 years of increases, low payout ratio, very secure.
Exactly. It all paints a picture of financial strength and stability.
Okay, so strong business, strong financials. How is the market valuing it right now? What do the valuation metrics tell us?
Right, valuation. Two main ways to look at it. First, relative valuation, comparing it to its own history and its peers. Abbott's trailing 12 months PE ratio as of June 2025 is around 17.2x.
17.2x. How does that compare historically?
Get this. Its 10-year historical average PE is almost 50x, 49.66x to be precise.
Ooh, that's a massive difference. What does that imply?
It implies the market is valuing Abbott much, much more conservatively now than it did over the last decade. The COVID premium seems completely gone. For a value investor, that kind of compression can signal an opportunity.
And compared to its peers?
It's roughly in line with a diversified player like Johnson & Johnson, which is around 16.8x, but it's trading at a big discount to more focused medical device companies like Medtronic, around 26x, or Boston Scientific, which is way up at 74x based on recent growth expectations, and also a discount to Diagnostics heavy Roche, around 27.6x. So relative to many key competitors, it doesn't look expensive.
Okay, that's relative valuation. What about intrinsic value? Trying to estimate what the business itself is truly worth.
Right, the second approach. Intrinsic valuation. We typically use a discounted cash flow or DCF model for this. The basic idea is simple. A business is worth all the cash it can generate for its owners in the future, discounted back to what that cash is worth today.
Makes sense. What assumptions go into your model for Abbott?
Okay, for our educational model here, we assumed near-term free cash flow growth around 7.5% to 8.5%. That aligns pretty well with the guidance management gave for 2025. Then we gradually taper that growth down over time to a more conservative perpetual growth rate of 2.5%, sort of in line with long-term economic growth.
And the discount rate, how much you discount those future cash flows.
We use their weighted average cost of capital, the WACC, which we calculated at 8.42%. That represents the blended cost of their debt and equity financing.
So plugging all that in, what does the DCF model suggest?
Based on those assumptions, our educational DCF model estimates an intrinsic value for Abbott Labs somewhere in the range of $165 to $175 per share.
$165 to $175, compared to the current price around $132. That does suggest potential undervaluation.
It does. According to this model, yes, the stock appears to be trading at a noticeable discount to its estimated intrinsic value.
Very interesting. Okay, we've built a strong foundation on the business, the management, the financials. Now let's see how the market is actually perceiving Abbott right now.
Market sentiment.
So what's the vibe from Wall Street? How are analysts feeling about Abbott?
Broadly positive, actually. The consensus rating you see out there is generally a moderate buy or buy. We're talking about, 26 to 31 different brokerage firms covering the stock. And sell ratings, extremely rare, almost non-existent.
And where are their price targets sitting?
The average or consensus target tends to fall between $140 and $148.
Okay, so from the current 132-ish, that implies what, 5% to 12% potential upside?
Something like that. It's healthy, but it's not suggesting, explosive growth. It's not wildly speculative. Individual targets do have a wider range, maybe $117 on the low end, up to $160 on the high end.
How about the general media narrative? Has it shifted since the formula recall?
It definitely seems to have shifted, yeah. Less focus on the recall fallout and the declining COVID test revenue. More focus now on the strength of the underlying core business. You see more positive news coverage lately. Things like new FDA approvals. They got one for the Tendyne mitral valve replacement system. Strategic partnerships, like integrating Freestyle Libre data into Epic's electronic health records. Strong clinical data releases.
So the narrative is more forward-looking now.
Pretty much. There's still some caution mentioned, about the 2025 tariffs, pricing pressures in diagnostics, but the overall feeling seems to be that management has a credible plan to navigate those.
What about specific market indicators? Short interest.
Very telling, actually. Short interest in Abbott is exceptionally low. It's just 1.29% of the float.
How does that compare to others?
Significantly lower. The average for its peers is more like 5.50%. So that very low short interest signals a real lack of conviction among investors betting against the stock.
Few people think it's going down significantly.
Technically, looking at the stock chart. Well, the price, $132.41. It's trading just a little bit above its 50-day moving average, which is around $131.50. That usually indicates a decent short-term trend. More importantly, though, it's trading comfortably above its 200-day moving average, which is down in the $122 to $126 range.
And that's generally seen as a bullish signal.
Yes, trading above the 200-day is typically considered a strong sign of a sustained long-term uptrend. It reinforces that idea of the market being maybe quietly confident about Abbott.
Okay, interesting sentiment picture. Next up, let's look inside the company. Who actually owns this healthcare giant?
Ownership structure.
So who holds the shares of Abbott? Is it mostly big institutions?
Overwhelmingly so, yes.
Right.
Institutional investors think pension funds, mutual funds, hedge funds. They hold somewhere between 75% and 81% of all the outstanding shares.
That's a huge chunk. What does that signal?
It signals strong confidence from arguably the world's most sophisticated investors. They've done their homework, and they're comfortable holding large positions.
Who are the biggest holders?
No surprise, it's the big three passive index fund providers. Vanguard is the largest, around 9.7%. BlackRock is next, around 7.9%. Then you have Capital Group and State Street, somewhere in the 4.5% to 7.4% range each.
So a lot of index money. Does that influence management strategy?
It tends to encourage a focus on stability, predictable performance, meeting index criteria, things like consistent dividends, steady growth, which aligns well with Abbott's profile.
What about insiders? Management and directors, how much skin do they have in the game?
Insider ownership is relatively low as a percentage, maybe 0.5% to 1.0%.
Doesn't sound like much.
Well, but remember, this is a mega cap company. Even that small percentage translates to over $1 billion worth of stock. So their financial interests are definitely aligned with shareholders.
Have insiders been buying or selling recently?
Looking at recent transactions, the pattern is pretty clearly selling. Over the last 12 months, something like 29 sales versus only 20 buys. And if you narrow it down to the last 6 months, it's even clearer. 15 sales and basically 0 open market purchases by insiders.
So insiders are selling, not buying. Is that a red flag?
Not necessarily a huge red flag on its own. Executives often sell shares periodically for diversification, tax planning, exercising options. That's normal. What's often more telling is the absence of significant insider buying. If they thought the stock was dramatically undervalued, you might expect to see more open market purchases. The fact that we're not seeing that suggests they might view the stock as perhaps fairly valued right now, but not necessarily a deep bargain.
Okay, so institutions own most of it. Insiders have skin in the game but haven't been buying heavily. Is ownership concentrated? Does any one group have control?
Despite the high institutional ownership, control isn't really concentrated. The top 25 largest shareholders together own just under 50% of the company. So no single entity has a controlling interest. Strategic control really rests with the board of directors and the management team.
And retail investors, individuals like you and me.
They hold a meaningful stake too, somewhere between 20% and 31%, depending on the data source. That diverse ownership base actually contributes to the stock's stability and liquidity.
Got it. Okay, now let's put it all together with a classic SWOT analysis. Strengths, weaknesses, opportunities, threats.
Risk assessment.
All right, SWOT analysis for Abbott. Let's start with the strengths. We've touched on these a lot. That resilient, diversified business model, powerful brands like Ensure, Freestyle Libre, a really productive innovation pipeline, 100-plus new products coming, their global scale and market leadership positions, and that fortress financial position, dividend aristocrat, low debt, strong free cash flow. Lots of strengths.
Okay, clear strengths. What about the weaknesses?
Well, despite being global, they still get over half, 52% of the revenue from the U.S. That creates concentrated risk if U.S. healthcare policy changes significantly. Just operating in healthcare means a high regulatory burden. Compliance costs are huge, $1.9 billion in 2023 alone, and they're always susceptible to FDA actions or scrutiny.
And the scale itself can be a weakness. It can. It creates potential supply chain vulnerabilities. They reported $672 million in lost revenue in 2023 just due to disruptions. And operational complexity, the 2022 infant formula recall, was a stark reminder of the risks involved when managing such a large, complex operation.
Okay, strengths and weaknesses understood. What about external opportunities?
Big ones here. Expansion in digital health and remote monitoring is huge. That market's projected to hit nearly $640 billion by 2026. Abbott's Libre and Lingo ecosystems put them right in the sweet spot. Growth in precision and personalized medicine is another major avenue. Increasing healthcare spending in emerging markets, where Abbott already has a strong presence. And that global shift towards preventive healthcare we talked about earlier. All big opportunities.
But opportunities always come with threats. What are the big ones facing Abbott?
Intense competition, as we discussed. It's constantly evolving. Patent expirations are a persistent threat in this industry. They have 6 key medical device patents expiring between 2024 and 2026. That puts an estimated $750 million in annual revenue at risk that they need to replace through innovation. Oof, that's significant.
It is. Then there's the constant pressure on healthcare pricing and reimbursement. Governments, insurers, they're always trying to control cost. Medicare rates, for example, decreased by 2.5% in 2024. That directly hits revenue. And being global means foreign currency fluctuations are a threat. Those alone can cause over 4% revenue variability just in emerging markets.
So connecting this to the bigger picture, macroeconomic factors, geopolitics.
Absolutely key threats too. Inflation, for instance. It increases their costs, raw materials, shipping, labor. And it could potentially dampen demand for more elective procedures if consumers feel pinched. Interest rates matter too. Higher rates make borrowing for R&D or acquisitions more expensive.
But rates might be coming down later in 2025. Could that be a tailwind?
Potentially, yes. If rates fall as many expect, that could make capital cheaper, maybe spur some new investment or make M&A more attractive.
What about geopolitical risks? You mentioned tariffs earlier.
Right. That's a very specific, quantifiable threat right now. The new wave of U.S. tariffs implemented in 2025. There's a 10% baseline tariff on most imports, but also a tougher 25% tariff, specifically on medical devices coming from Canada and Mexico.
And that hits the device industry hard.
Very hard, because something like 69% of medical devices used in the U.S. are actually manufactured only outside the country, so they're very exposed. Abbott's CEO, Robert Ford, he estimated the direct hit for Abbott in 2025 would be a few $100 million.
Not insignificant.
Not at all. And interestingly, he said the company decided to absorb that cost for now rather than raising their earnings forecast to offset it. They're trying to mitigate it using their global manufacturing footprint. But Ford also candidly said he believes tariffs, once they're imposed, don't go away. So it looks like a persistent cost headwind they'll have to manage.
Okay, that gives us a really clear view of the risks and opportunities. Let's try to synthesize everything now. So, after digging through all of this, what's the final takeaway? Let's distill the bull case and the bear case for Abbott Laboratories. What's the argument for investing?
Okay, the bull case. It rests on several strong pillars. First, that resilient, diversified business model. It's proven it can handle shocks. And its return to strong organic growth post-COVID shows its durability. Second, they have durable competitive advantages, those moats we talked about, especially in high-growth markets. Ecosystems like Freestyle Libre, their diagnostics platforms, they lock in customers, generate high-margin recurring revenue. Third, exceptional financial strength, low debt, consistent free cash flow, that incredible 54-year dividend growth streak. It's a picture of stability. And finally, management has a proven track record of smart capital allocation. That ROIC consistently beating their cost of capital is key evidence they create shareholder value.
Okay, that's a compelling bull case. What about the other side, the bear case? What are the arguments against?
The bear case points to real challenges. Persistent headwinds, those macro factors like tariffs, Industry pressures like patent expirations, intense competition, downward pricing pressure from payers, these aren't going away. Their concentration risk, with over half their revenue still tied to the U.S. market, makes them vulnerable to shifts in American healthcare policy. The 2022 infant formula recall, while hopefully behind them, serves as a stark reminder of the operational and reputational risks inherent in this highly scrutinized industry. One slip-up can be very costly.
And valuation and insider activity.
Right. While our DCF model suggests undervaluation, the stock's PE ratio isn't dirt cheap compared to the overall market. And that pattern of consistent insider selling, with no significant insider buying lately, it suggests that even those who know the company best might not see the shares as dramatically undervalued right now. Maybe just fairly valued or slightly undervalued.
So bringing it back to the valuation model.
Right, based on our educational DCF model, remember those assumptions. Initial 8% FCF growth tapering to 2.5% perpetual growth, and that 8.42% discount rate, we estimate that intrinsic value for Abbott in the range of $165 to $175 per share.
Okay, so what does this mean for you, the listener, the potential investor? As of June 24, 2025, the share price is $132.41. That is trading at a notable discount to that $165, $175 estimated intrinsic value range.
It certainly appears that way based on our model, yes.
So it suggests the market might be focusing more on those near-term headwinds, the tariffs, the pricing pressures, the post-COVID normalization, perhaps more than the long-term durable strengths that we spent time discussing.
That's a plausible interpretation, yeah.
So ultimately, Abbott Laboratories looks like a high-quality, very stable, well-managed healthcare giant. It appears reasonably priced, maybe even undervalued, with potential for long-term appreciation.
Provided, of course, they continue to navigate that really complex and challenging environment successfully. Execution remains key.
Absolutely. So what stands out to you about this deep dive? How do you personally weigh those immense durable strengths against those persistent external risks?
Definitely something to think about as you consider the future of healthcare and this really enduring company. And that wraps up our deep dive into Abbott Laboratories. If you found this valuable, please do hit that like button, share it, and subscribe to the Stock Analytics AI YouTube channel. And remember, members can suggest stocks for future deep dives right there in the comments section.
And just one final crucial reminder, this analysis was generated by an AI system. It's purely for educational purposes. It should absolutely not be considered financial advice. Please always do your own research or consult with a qualified financial advisor before making any investment decisions.
Thanks for diving deep with us today. We'll be back soon with another stack of sources ready to uncover those important nuggets of knowledge.